Hey folks, we now want to take a look at how to calculate the full goodwill method, which is 99% of the time what I would expect to see on the CPA exam. But there's always the chance that the IFRS only partial, and by the way, it's only an election. They allow the full goodwill, but there's also this option of the partial goodwill method. So we're going to take a look at the calculation of both. In essence, if a company had a book value and we paid a lot more for it, but we only bought 80%, well, then we say our 80%, we paid the premium. There's an implied value to the non-controlling interest. So we would literally write that up to that implied value, which would include their percentage of the goodwill. Or we can just say we get our goodwill, but they didn't pay for theirs, so we're not going to show theirs. So there's two ways of doing the calculation. The most important one, if it overloads your head, remember, make sure you understand the full goodwill method. If you're okay in understanding both, great. That would be a very defensive knowledge just in case they ask a question there. So let's take a look at how both calculations are made. So let's start out with the full goodwill method. Full goodwill method would be what is the total fair value of the sub. Now, we bought 80% of the company for $8 million. That presumes that the total company must be worth $10 million, because if $8 million is for 80%, then $10 million must be 100%, which means the portion we didn't buy is worth $2 million. So what we would do is say the fair value of the sub minus the fair value of their tangible assets, whatever that was, the balance is the goodwill, and we get 80. The non-controlling interest, they're going to get the other percentage. So the non-controlling interest gets the fair value of the sub times the non-controlling interest, the percentage we don't own. And that would have an embedded goodwill number within it. On the other hand, if you're going to use the partial, notice now it's we take the acquisition cost and we compare it to the fair value of the sub's net assets acquired. This ultimately creates goodwill only for the parent. Notice it's not the total fair value of the sub, it's the price we paid. We paid a premium for our share of the goodwill. We did not pay a premium for their share, the non-controlling interest share. So therefore, this difference would equal the goodwill, but only the goodwill that is applicable to us. The non-controlling interest then would have the fair value of the sub's net assets, not the total value, just the assets that are there, because goodwill is not one of the net assets that the sub has, and therefore then times their interest. And notice that would equal their share, but it would exclude goodwill because we did not include the intangibles in that calculation. And that's the easiest way to understand how this formula is done. And hopefully with that, you'll be ready to try a full-blown exercise.